Aloha, y'all. This is Lahaina Lee with your Maui Real Estate Advisor year-end wrap-up for 2025. Grab your popcorn, y'all. This is going to be a long one. As we close out 2025, one thing is pretty clear. This was not a normal year for Maui real estate, and honestly, it wasn't meant to be. This was the year when uncertainty stopped being something we talked about in theory and started showing up in real policy decisions. It was the year recovery continued, but not evenly, and the year that the market stopped reacting emotionally and started adjusting to a new reality. For buyers, sellers, investors, and property owners, 2025 forced a reset. Expectations changed. Risk had to be repriced, and the gap between headlines and what was actually happening on the ground became more important than ever to understand. This isn't a promotional recap, and it's not a prediction piece. It's meant to be useful. What really happened in 2025, what actually mattered, and what should we be paying attention to as we move into 2026? For most of the past 2 years, Bill 9 lived more as an idea than a reality. We heard draft language, amendments, public testimony, and a lot of political messaging. In 2025, that changed. Bill 9 became law. And it's important to slow down here and be very clear about what that law was and how it evolved. For those who wrote and supported it, its purpose didn't even remain the same from the time it was proposed to the time it was passed. At different points, it was framed as a housing bill, an affordable housing solution, a workforce housing measure, and eventually a zoning correction. One moment that really highlighted this problem was the creation of Exhibit 2, what I called the safe list. When deciding which condominium complexes would be exempted, luxury resort properties, including Kapalua Golf Villas and the Ridge Villas, were not included with the justification that we need housing at all price points. Now that may seem reasonable on the surface until you look at how real estate actually works. Anyone who wants to live full-time in a resort zone or a hotel zone condominium can already do that today, just like Barbara and I did for 17 years until it burned down. Zoning doesn't prevent owner occupancy, and changing zoning doesn't suddenly make a property affordable. Including luxury resort properties under the banner of housing at all price points confuses ownership with use, and it exposes a real gap between rhetoric and reality. From the beginning, our concern was never framed as housing versus tourism. We need housing, period. And our economy needs tourism, period. The temporary investigative group, which I'll talk about next, tried to address both the economics and the sequencing of any changes. In 2025, those concerns weren't resolved. What did become clear was this: the bill was passed before replacement hotel zoning mechanisms were in place. Enforcement timelines exist on paper, but implementation details are still unclear, and lawsuits have moved the next phase of this issue out of the council chambers and into the courts. So the takeaway from 2025 is fairly simple. Bill 9 is now law, but its real-world impact is still unsettled. One of the most important and frankly one of the most misunderstood developments in 2025 was the temporary investigative group and its report. Most people just call it the TIG. What made the TIG different wasn't politics, it was math. For the first time, the county put real numbers on the table and forced a conversation that had been mostly avoided up to that point. We're talking about trade-offs: tax revenue, visitor spending, jobs, housing feasibility, and how zoning decisions actually play out in the real world. The TIG highlighted something that many property owners already understood, but that hadn't been acknowledged publicly. A significant number of apartment zone properties were never designed to function as long-term residential housing. Not because of ideology, not because of bad intent, but because of reality. What a concept. Size matters, location matters, and the cost of maintaining the property matters. Those high monthly maintenance fees or commercial level operating costs, those don't just disappear because zoning or use has changed. In many cases, most, the cost structure alone effectively disqualifies these properties as affordable housing, regardless of how they're zoned. That's not a political statement. Again, it's just math. The TIG tried to deal with this by proposing a fairly straightforward two-step approach. First, identify properties that clearly function as visitor accommodations and move them into appropriate hotel zone classifications. Then, and only then, focus housing policy on apartment zone properties that can realistically support long-term residential use. That sequencing matters, and it remains unresolved heading into 2026. What was also concerning was how the process played out. At the very first county council meeting intended to address the rezoning process, some council members appeared to be more focused on delaying or undermining the resolution than moving it forward to a workable path. That moment reinforced one of the biggest lessons of 2025. Progress is possible, but it's not guaranteed. Turning to Lahaina. Lahaina continued to move forward in 2025. That statement is true, and it's also incomplete. There was progress, more structures were completed, and infrastructure continues to return. Limited harbor operations returned, but normalcy did not. We won't get there for a while. One moment really brought that home to me. I was standing on Front Street next to a lot that I was getting ready to list. I looked around and I could see signs of progress. Just days earlier, the county had proudly announced that 100 homes had been completed, and we should be proud of that milestone. But standing there, the math hit me. It had been 2.5 years since roughly 2,200 properties were destroyed, and only about 100 have been completed. That is progress, and it's also a reminder of how far we still have to go. Recovery isn't a single event, it's a long sequence. In 2025, Lahaina moved from response to staging. That matters, but it's not recovery, and it's certainly not normal. Turning to Maui's economy, compared to 2024, Maui's economy kind of improved in 2025. It might depend on who you ask. Visitor counts came up, activity stabilized, and at different points in the year, it even picked up. But there was still a sense of free fall in real estate, and free fall in short-term rental income. Two structural issues became much clearer. The first is this: Maui's economy depends on tourism, and tourism depends on people. Since the fire, hundreds of residents have left the island. For businesses that survived, staffing was already an issue, but that was exacerbated and became one of the biggest problems. This isn't a short-term disruption. This is structural. The second issue is that even as tourism numbers improved, profitability often didn't. Competition forced rates down, sometimes below break even. Occupancy improved, margins disappeared. Revenue existed, profit often didn't. And if you run a small business, that distinction is the difference between life and death. The takeaway isn't pessimism, it's realism. Maui got by in 2025, but it did so under pressure and with very little margin for error. Now, this is the Maui Real Estate Advisor, right? If 2025 taught us anything about real estate on Maui, it's this: there is no single global Maui market. What we really have, and what we've always had, are multiple markets moving at different speeds under different pressures and for different reasons. It's a lot like our climate here on Maui. We have beaches, we have the cool heights of Haleakala, we have rainforests. Real estate works the same way. We have micro markets all over the island. Let's start with condos. For most of 2025, the condo market was firmly in the buyer market territory, but buyers didn't exactly rush in. Buyer activity was light, cautious, and downright hesitant. Some of that is uncertainty around zoning. Some of it is the lack of clarity around future use. But honestly, some of it is just a general negative vibe coming from news stories, headlines, and social media. All of that causes buyers to slow down. For sellers and their agents, this is one of the toughest markets many of us have ever tried to navigate when it comes to pricing and marketing. Even very experienced, seasoned agents struggle to determine what kind of price will actually attract serious attention. Properties set, showings are limited, even online views, which are usually strong, are much lighter than normal. Most condo sellers still have pretty solid equity, and we're not seeing desperation. But even for sellers who are very serious about selling, there isn't a clear answer to the question everybody keeps asking. What price would even get someone to take a serious look? This isn't a normal buyer's market. It's a market constrained by uncertainty. Now, single-family homes tell a different story. That market continues to segment sharply by quality, condition, and location. Well-priced, well-presented homes still sell. Homes that are aspirationally priced, not so much. And there isn't much middle ground. And then there's the luxury market. Despite a lot of headlines, luxury didn't crash. It doesn't crash. It kind of chugs along, same as it ever was, and adapts. We frequently see long marketing timelines, sometimes significant price reductions. Listings that have been on the market for a while are pulled and then later reintroduced with 0 days on market. Maybe we're not fooling anyone. And something interesting this year is we saw a bit of a return to luxury auctions as a price discovery tool. Luxury buyers are still out there, but they're smart, not impulsive. They're patient, they're analytical, and they demand value, clarity, and realism. Now, for investors, 2025 became a year of recalibration. Not because they suddenly got smarter, but because the environment they were operating in changed. Risk stopped being something people talked about in theory and became something they had to deal with in real life. Regulations came with hard timelines. Insurance, and therefore HOA fees, became much more expensive and less predictable. The result is simple. Monthly carrying costs increased, and owners can no longer assume that a quick, easy sale is a reliable exit strategy. What really changed, and still is changing, is that a lot of long-standing basic underlying assumptions stopped holding up. Assumptions about stability, assumption about continuing owner rights for preferred use, and assumptions that regulatory change will be slow or maybe not happen at all. Those assumptions were valid and they've worked for a long time. Hell, they've been law, but they don't necessarily work anymore. Investors slowed down, got back to basics, and really asked themselves, how long can I realistically hold this property in a changing and sometimes unfriendly market? How much cash flow variability can I tolerate? What happens if income drops or drops again? And what does a real downside, even worst case scenario, actually look like? For some investors, that means reassessing leverage. For others, it means reassessing exit strategies. And for some, it means reassessing whether holding makes sense at all. And a lot of folks are still trying to figure that out. 2026 will not be a year that rewards bold assumptions or aggressive projections. It will be a year that demands realism. And that mindset isn't going away, although there are bargains for clear-eyed, disciplined buyers. As we move into 2026, few things matter more than clarity. We need to understand what the rules are going to be, and we need to understand whether this county government can actually govern by finding some kind of workable compromise between an almost radical ideology and economic reality. Right now, a lot of the biggest questions remain unanswered. We don't yet know how the courts are going to rule on the lawsuits tied to Bill 9. We don't know whether injunctions will change the timelines or the enforcement. And we still don't know how consistently or how aggressively the county will eventually apply the rules that have already been passed. We're also watching to see whether proposed hotel zoning solutions move beyond discussion and actually turn into something workable. Ideas are easy, execution is hard, and execution is what's missing right now. At the same time, we're heading into an election year. That matters. Politics has a way of influencing timing, tone, and follow through, especially when issues are complicated and the stakes are high. Let's be honest. When some politicians are worried about their jobs, winning can start to be more important than governing. Tourism will continue to be a major part of the conversation. Not whether people will keep coming to Maui. They will. The real question is how strong demand will be in a tougher local and national economic environment, and what that means for pricing power, staffing, and long-term sustainability for businesses that are already operating on razor-thin margins. So as we look ahead, the challenge isn't predicting the future. It's planning for multiple outcomes. That means being realistic about risk, being realistic about timelines, and be willing to adjust as new information comes in. And that brings me to the most important point. 2025 did not deliver clarity. It shows how much uncertainty exists around zoning, enforcement, litigation, interest rates, and the broader economy. What we do know is this: pretending certainty exists when it doesn't is risky business. In an environment like this, confidence without context is dangerous. What actually matters now is judgment, thoughtful judgment, local judgment, judgment grounded in data, experience, and an honest understanding of how Maui really works today. That's the lesson of 2025, and that's the mindset we carry into 2026. Thanks for tuning in. If you have comments or questions, drop them below or shoot an email to lee@alohapots.com. I answer every one. If you like this episode, give us a like and maybe send it to someone you know who's thinking about Maui. And if you haven't already, subscribe so that you don't miss a thing. If someone you know is thinking about buying, selling, or just keeping track of Maui's real estate market, we've got a fabulous team of seasoned, well-trained agents standing by to help you. That's all for now. From the greatest island on earth, this is Lahaina Lee saying, aloha! Tony Brown produced this podcast. The information provided in this podcast is for educational and informational purposes only. It's not intended as a recommendation to invest in real estate or any other financial asset. We are not financial planners, certified public accountants, or attorneys. You should consult with a qualified professional before making any financial, legal, or investment decisions. All investments carry risk, and past performance is not indicative of future results.